Capital gains tax. Yes, can be a little confusing. I'm going to explain in this video exactly what capital gains tax is, how much you will have to pay, if you have to pay it, a bunch of other sort of stuff, and I'm going to go through an exact example so you have no questions whatsoever and everything will be crystal clear. So grab a notepad, grab a pen, grab your phone, everything you need. I'm knocking stuff here, we'll get to it right now. My name is Connor Mangan. I am a real estate agent here in Toronto. Also work a lot of commercial and multifamily stuff all around Canada and the US. Please like and subscribe. Please share this video, especially with maybe some of your investor friends, maybe people who are thinking about selling, anything like that, because this will apply to them. What is capital gains tax? Capital gains tax is when a capital event occurs. So basically you sell something like an asset or a stock and you've made a gain. So what does that mean? Okay, I bought Apple stock for $1 and then a year later I sold it for $2. That means you've made a gain, right? You've made a profit. You made $1 on that Apple stock. So therefore you have to pay capital gains tax. You don't have to pay capital gains tax on $2, which is what you sold it for. It's only the gain, which is $1, and capital gains is 50% of that gain. So 50% of that gain is 50 cents. So you got to pay tax on 50 cents. And so that is your capital gains tax. Okay, so how does it apply to you? Okay, so if you have a capital gain in a certain tax year, basically that gain is, as we said, 50% of that is capital gains tax. So let's say you made a gain of $100,000, so 50% of that becomes tax. That's $50,000. Now let's say you are employed and you're working that year and your income was, let's just say $80,000. But then you had that capital gain and the taxable amount of that was 50%, so that's $50,000. So you got to add the $80,000, which was your income for that year, plus the capital gain of $50,000, and then you just got to pay your regular, that becomes your income then for that year, and you just pay your regular tax on that you would have paid normally. So you know, if you're making about 100 grand a year, you're paying like roughly 30% tax. I think it's 29,800 or something. So if that 80,000 that your regular employment income plus the 50,000, that equals 130. So now your income for that year was 130 grand. So you got to pay tax, income tax for 130 grand. That's exactly what capital gains tax is. It sounds worse than it is when they say like, oh, you got to pay, it's 50%. People are thinking like, oh my God, 50% of my gain is all gone. It's going to be a disaster. I'm going to sell my house for, $900,000. I'm going to have to pay 50% tax on it. Like that is just, why would I ever do that? It's not quite like that. Okay, it's a little bit simpler than that. It's only the gain per se, the actual exact gain. And then it's only 50% of that. You can write off any of those expenses that cost you to get that gain. So if you list a property and your realtor fees, let's say you list a property for $800,000 or $900,000, your realtor fees, your closing fees, your lawyer costs, improvements to the property that you made, the renovations, all those types of things.
So that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
They're all deductible on those gains. So you can write off all those deductions so you actually don't have to pay any tax on anything that you paid for to improve the property or you use to close it. So if your realtor fees and lawyer fees add up to somewhere around $50,000, you can take that whole 50 grand because you already paid it. You don't have to pay tax on it again.
Who writes it off?
I don't know. The write-off people. What?
You can take that off your gain so that it doesn't come into that bracket of being the 50% of it being eligible for capital gains tax. Okay, so very, very important. Use a realtor so you can write off all those taxes and you don't have to pay it. Okay, we are worth it. Trust me. Now, let's go through an exact example so we don't have any questions. Okay, now, excuse my handwriting. I used to be a teacher, so all teachers, especially maths teachers, have atrocious handwriting. That's just a fact of life. Anyway, so this is our 1 bed plus 10 condo downtown. So client paid $550K for the condo, okay? He sold 2 years later and he sold it for $800,000, okay? Everyone with me so far? So when you sell something for more than what you paid for it, with an asset, stocks, etc., you actually make a capital gain. Okay, so that's a difference of, so your capital gain was $250,000, okay? Key number there, that's the capital gain for that day. And any capital gain is taxed at, the amount of it that's taxable is 50% of it. Okay, that's taxable. Okay, still bear with me. Now, any type of capital gain is subject to deductions, so you can deduct any expenses, anything that went in towards selling it. So let's say we have deductions here, and they included realtor fees. So again, your realtor is going to do all the work for you. He's going to sell it for you. He's going to put in the hours, or she's going to put in the hours. They're going to get all the work done. They're going to do all the paperwork, all that sort of jazz. And you can write off all of their fees. So great idea to hire a realtor. So realtor fees, let's say there's lawyer fees on top of it. Then there are closing costs, etc., etc. Maybe there was some upgrades, some renovations that you did that year to sell. So let's say, for example, there was a new bathroom, and it's a condo, so maybe the bathroom costs 10K. So let's say all those together equals about $50,000. Okay, there were your deductions. So this $50,000 you can take away from this guy. Okay, so let's say that was your gross capital gain. This is your net capital gain. And let's double check that you can see everything that I'm doing. You can. Again, atrocious handwriting, I apologize. $200,000 is your actual capital gain there. Okay, great. So as we said, 50% of this is taxable. What's 50% of $200,000? So that's 200K by 50%. So you can multiply by 0.5, you can divide by 2, whatever way you want to do it. That's going to give you $100,000 that will be taxed. You have to pay tax on that just as if it was your income. So that gets added to your income. So add to income. Now, for this particular client that I'm talking about, his income was actually zero for that year. Multiple reasons for that, but income for tax year is $0. Okay, so whatever it is, you're gonna add this, whatever your capital gain is, your net capital gain, you're gonna add this to your income. So add net capital gain, which is, as we said, net, let's say taxable capital gain, just to make clear, net taxable capital gain is going to be $100,000. So total to be taxed is 100 grand. Let's hopefully you can still see that down there. You can. And in Toronto, in the GTA and stuff, that's roughly going to be the tax rate is around 30%. So this guy actually ended up paying $29,897 in his capital gains tax for a condo that he sold for $800,000 or $800,000. Okay, so it's not like this insane amount. Now it is a lot of money. Let's just say that, but it's maybe not as much as people think with the capital gain. So he made $250,000 in his capital gain, and then with all the deductions and everything else, which was 50K, he was 100K there. Okay, so and then 50% of that was tax deductible. So out of the 200,000 that he actually made, so out of the $200,000 was he made, he had to pay 30K in tax. So he still walked away with 150k plus all those expenses and everything else. If he didn't have those expenses and it was 150k, he didn't take any deductions away from it, he would have got taxed at a much higher rate, and that would have gone all straight to the tax man, straight to the government. So it can be a good idea to use this. Now, bear with me for the next part. Whew. Okay, we got through that. Well done, everyone, for sticking with me on that. I just always like to go through this exact example so we know exactly what we're talking about, and there's no, go back over the video again, use another example. You can see exactly what your situation might look like. So I hope that video was informative. Again, what is capital gains tax? It's a capital event occurs and you made a gain. If you actually made a loss on it, there is no capital gains tax. So if you bought a property for $500,000, market wasn't doing great, you had to sell, you sold for $450, you don't have to pay any capital gains tax because there was no capital gain. So don't worry about any of that sort of stuff. 50% of it is eligible for capital gains tax. That whole amount then gets added to your income for that year. So if you can move that to a year where you're not making a lot of money, if you can sell in a year where you're not making a lot of money, you will probably pay less tax on that. And then we looked through the specific example and we saw exactly how much they were paying capital gains tax. So again, my name is Conor Mangan. I'm a real estate agent here in the city. I work very hard. I work 7 days a week. If you were thinking about buying or selling, if you know anyone who's buying or selling, please contact me. I will talk you through everything from capital gains tax to marketing to listing to how to present the property and sell it for the maximum price. Okay, and we will talk to you soon. It's getting to Christmas time. I can't wait. I'm just about to go eat some turkey sandwiches.
Time to keep on dancing, to walk that line, yeah. You got me shifting.